Welcome to Passive Cash Flow for Life through Multifamily. We meet the fourth Wednesday of every month. When we do it live, we do it at Timbuktu Restaurant in their banquet hall. And we do that again the fourth Wednesday of every month. Obviously with COVID, we stopped doing it there and we went virtual, but probably I think in June, we're going to start going back to live and in person. And then for all the people like you, Terrence, we'll try and live stream it as well, so everyone can participate. We've had a lot of people from outside of the area started to join, so we want to make sure that we're able to serve you guys as well. So my name is James Ray. I'll be your host for tonight. And this meetup is all about apartment buildings, mobile home parks, and self-storage facilities. Every fourth Wednesday of every month, we bring in a speaker to talk about things to do with multifamily. Something that'll help you guys grow your business if you're doing that, or just invest passively if that's what your interest is, or maybe you have an interest in both investing yourself and also investing passively, and that's what Jason's going to talk about. Nicole, my partner, is on as well. Nicole has thousands of units across the US. She's been invested in commercial real estate for over 20 years. I keep wanting to say 25. I think it might be 25. And she's going to be helping us host as well. And for those of you that don't know, Nicole has taken her 25 years of experience and put together an amazing online course on how to be successful in multifamily, what to do, what not to do. We've had great success with it, really a lot of great feedback. If you have an interest, you can go to passivecashflowforlife.com and you can kind of take a look at all the stuff that's available for you. If you have an interest, great. And if you don't, that's fine too, but just wanted to throw it out there. We've had a lot of great success with it. So Nicole, you want to say hi?
Hi, everybody. And I just wanted to let you know, James and I are talking about in June, at the very end of June, doing a kind of a one-day mini introduction to investing, face-to-face, and we'll live stream it, introduction into multifamily. So a lot of you may have already been there, and if you haven't, it'll be available to come out and see if you think multifamily might be for you. It's going to be a real nominal price, so hopefully you can kind of keep that in mind, and we'll let you know in the next couple of weeks when we're going to do that. So and I want to welcome Jason and tell him thank you very much for donating part of your evening to us. We really appreciate it, even though I'm jealous as you know what. I'm sitting down here in my basement office, and he's out there in the evening sun in southern Florida or central Florida. So thanks again, Jason.
Yeah, happy to be here.
Sorry. So what we're going to do is a couple of housekeeping notes. Sometimes we actually wait to do questions and answers at the end, and I think we're going to try something a little bit different. We're going to let you guys ask questions as we go through. Obviously, wait for a pause in the conversation if you wouldn't mind to ask a question. There was a way, I can't seem to find it, for you to be able to raise your hand on here. And, oh, there it is. Okay, so if you go to reactions, it says raise your hand. So if you have a question, just go ahead and raise your hand. You can just click on that, and then as soon as I get a chance, I'll try and jump in when Jason is speaking, and then you can unmute yourself and ask the question, and hopefully we get some dialogue going. So again, just go to reactions, click on raise hand, and then as soon as we get a break, I'll call on you. You can unmute yourself, and you can go ahead and ask your question. So
yeah, we're really going to try and make this be a little bit more interactive. So we really would encourage people to please ask questions and start making this a little more your meetup too.
Absolutely. We're also going to be, we're all recording this now. What I'll do is sometime later this week, I'll edit it and actually put it up on our YouTube channel. We're also posted on Facebook. You can find us at Multifamily Passive Cash Flow for Life on YouTube and on Facebook. And then also, obviously, if you're on our mailing list or you're on our meetup group, we'll send out the link to the recording along with all of Jason's contact information. He's been incredibly helpful with a lot of our people. So if you guys have questions after the meetup, you can reach out to him directly, and either he or someone on his staff will be more than happy to help you. So Jason DeBono is the person that's going to be working with us tonight. He is the president of NuView IRA, which is a self-directed custodian company with over $1.5 billion of assets. Jason, I did not know you were that big. That's pretty amazing, $1.5 billion. They specialize in helping real estate investors invest and save taxes via their IRAs, Roth IRAs, self-directed IRAs, and other tax-saving vehicles. Jason also provides continuing education to CPAs, attorneys, and real estate professionals, and has been a guest speaker at hundreds of investment events and conferences throughout the United States. So Jason, thanks so much for being with us. We appreciate you taking the time away from your family, and I'm just going to go ahead and hand it over to you.
Wonderful. Well, James, Nicole, thank you for having me, and to everybody else virtually. Good to meet you. Normally, I actually, this is the first time I've ever done a webinar, certainly outside. We just moved, and I've got boxes stacked up in what would eventually, hopefully, be our office. So, and I've got a child that's been sick, so this is probably the quietest place. But I do have 2 kids and a dog, so I can't make any guarantees that you won't see something running behind me. But hopefully, this will be quiet and fun. As James said, you know, our business is a lot bigger than most people think, and it's because so many people have an appetite to hold alternatives, and retirement accounts become incredibly attractive for that. So we're approaching the $2 billion mark. I've been with the company for 16 of their 18 years in business. When I started, we had $56 million in assets, and we have grown over those years. And personally, I think I've benefited equally as much as I have professionally from the opportunity, because I've been able to learn through the eyes of people just like you on things to consider, opportunities to review, and investments to go make. And so I am also an investor. I'm invested in a couple different apartment complex deals. I'm invested into a low income multifamily project as well. So I've gotten to see through the eyes, again, of consumers just like you. And I learn a little bit every day. So I'm going to take advantage of that opportunity and not make this a PowerPoint where I tell you all about the great things. But I'd love if you guys will help educate me into the things that you're seeing. Every market's a little different. Every asset class is a little different. Every individual is a little different. So I invite you to chat through this process. As James mentioned, we'll use the raise your hand function at first. If for any reason that becomes a challenge, you can't find it, just type either, you know, I've got a question in the chat, and that'll get to us. It's easier than everybody at once chiming in. So ask as we go. And if it is something that I am going to cover, I may respectfully ask to get to it in a bit. Otherwise, we'll stop, slow down, speed up. But you guys really can dictate what we cover over the next 30 to 40 minutes. Believe me, I can drone on, no problem, uninterrupted. But I assure you, for my sake, for your sake, it's a lot better when it's interactive. So, and it's a lot more fun for all of us. What I would ask everyone to do, and I know most of you are on, you know, computer, phone, something, is open up an email. And I'm going to give you my personal email address. And the reason I want you to do that is money is personal. And if I do mention something that triggers a question, or, you know, you don't really want to ask it in a group setting, type it into that email. And when we're done, hit send. And I'll make sure to get those addressed. But I find that a lot of people hold some of those personal questions, and I get it. But I'll invite you to kind of create a way to get those thought out at the time and ask. So my email is Jason, Jason, at NuView Trust with a U, NuView Trust.com. Again, you can put your questions in there that are personal. But I would ask that as we go through this, the whole goal is to keep this casual and to have some fun. So I am going to make it as interactive as possible. I'll have some questions. We'll use the chat function. Those do pop up on my end. So I guess with that said, are we ready to go, James? Are we good?
Yeah, absolutely. It's all yours.
All right. Well, the first question I'm going to ask, and I'll ask you to use the chat box there, is on just a scale from 1 to 10, 10 being level expert, 1 being you don't know the first thing about it. If everyone could just throw that number in on where you think you are in understanding self-directed IRAs. So whether 10 would mean you're doing it, you understand it, you would be happy to tell your friends how to do it. 1 or 0 means you don't know the first thing. So I see a 4, a 7, a 9, an 8, a 0, an 8, a 4. All right. So that gives me some perspective. So thank you guys for that. So we will, I will make sure to cover this at times. We'll try to get to the 8 or 9 and talk at that level. And at times we're going to drop down to the 2 or 3 to make sure that everybody kind of has a handle on it. So we're going to talk today about 2 different perspectives. And we're going to start with how to be a passive investor into real estate or real estate syndication, whether it be multifamily, self-storage, it really doesn't matter. And the reason is I find that before you go out and tell potential investors how to use this as a tool, it's much easier to understand how you would do it if you wanted to. And it starts to look the same from the investor perspective. So we're going to start with the very general premise of what self-directed accounts are, what they mean. So most people ask me, well, what's a self-directed IRA as it relates to a regular IRA, and how's it different? And the first analogy of many that I'll probably use today is it's kind of like fast food. It all looks the same, but there's a big difference between a burger, right? Burger King, McDonald's, and tacos that you would get at, say, a Taco Bell or a Del Taco. But at the end of the day, they're all the same. And I think the retirement industry is very similar. So retirement accounts all look the same, right? Traditional, Roth, simple, SEP. We'll go through and talk a little bit more about some of those. But at the end of the day, an IRA is an IRA. What's different is the menu of investment choices, just like the menu at a fast food restaurant. So when you go to your Schwab's, Fidelity's, TD Ameritrade's, right, Merrill, their menu is going to be anything publicly traded: stocks, bonds, mutual funds, ETFs. When you go to someone like an alternative custodian like NuView Trust, you're going to a menu that's got things like real estate, private equity, promissory notes, precious metals, cryptocurrency. So these are non-correlating assets. They're not publicly traded. They're not publicly listed, but they're readily available for investment. So when people come to us, it's not because they think that because we offer them some unique service, it's because we're just simply willing to custody investments that Schwab is not. Just like when you go to a Taco Bell, it's not that they're different from McDonald's. They're just willing to make you a taco. Whereas if you go to McDonald's, they could serve you a taco, but it's not really in their business model. So I want everyone to kind of understand we didn't reinvent IRAs. We didn't invent IRAs. We simply offer an asset class that the brokerage firms simply don't want to custody. So you're not using a loophole. You're not doing anything unique. You're not doing anything that the IRS deems questionable. You're simply buying an asset class that's been available since IRAs were created, but finding a custodian was always the struggle and challenge. And as our industry's grown, as people like James and Nicole continue to educate people like yourselves, the world that we occupy has gotten much bigger. I can tell you when I started this 16 years ago, if I would have asked, now it wouldn't have been via Zoom, for people to hold up their number in their hands, it would have been mostly 1s, 2s, and 3s out of 10. And here we are where most of our answers were 6, 7s, 8s, and 9s. And that just tells us that the industry's come a long way. So self-directing your account is not a new IRA. It's not a unique IRA. It's simply making a choice to choose a different asset class and then finding a custodian like NuView Trust that's willing to let you access that asset class. So when we look at what you can do, there are no rules that say you can buy real estate. There's no rules that say you can buy stocks and bonds. The rules only tell us what we can't buy. And the only 2 asset classes prohibited in an IRA are life insurance and collectibles. The second rule that we have to be mindful of is that the IRS doesn't want us, because of the tax benefits, investing into assets that we personally benefit from or any of our family members. And they consider these disqualified parties. Those parties are you, your spouse, your parents, your grandparents, your children and grandchildren, and the spouses and businesses of those parties. So think of it like the trunk of the tree. And their rationale is that because your IRA is tax advantage, they don't want my IRA buying a property that I own today, right? Because I would have to sell it to my IRA. Well, from a tax standpoint, it would be advantageous to sell it at a severe discount, right? So I take a loss on my personal tax return and then dump this asset into an IRA where it could grow tax-free. So ultimately, when you buy in an IRA, you have to be a arm's length passive investor. And as long as you check that box off, you're good to go. But I want to share why IRAs are so impactful and so many people overlook them. And I'd be willing to bet many of you guys on the call today probably don't really give IRAs enough consideration in your own personal portfolio. So many people tell me, especially investors, they say, well, my real estate is my investment program. And just remember that IRAs are a vehicle. Real estate is an asset. Those two things are separate, right? And they can be together or they can be separate. But I want to just share a quick wealth building story about why you should be considering an IRA for every deal that you do. And if you're not maxing out your IRA and buying alternatives with it, you're leaving money on the table. So one of the things that I like to share is that if you want to make money, buy investments. If you want to build wealth, buy investments in the most efficient tax manner. And there's an inherent difference between the two, and I'll kind of illustrate that quickly. And I'll use James as an example, and I'll use myself. So if I were to take $1 and I were to double it over the next 20 years, right? $1, and whatever the investment is, it doesn't matter. Call it self-storage, call it, multifamily, but that asset is going to double every year for 20 years. And I can do that investment personally, and I'm in the 25% tax bracket, right? So I invest the dollar. 20 years from now, I'm going to be sitting on a call like this, and I'm going to be telling you guys how I turned $1 into $78,000. Now, most of you guys are going to go, wow, in 20 years, what a great investor. $1, $78,000. What people don't realize is that dollar that turned into $2 really only became $1.75 because I made $1. Uncle Sam took 25%, and I only had the 75 cents I made and my original dollar to reinvest. Then I take that $1.75, double it to to $3.50. Then that $1.75 of profit gets taxed at 25%. And I do that every 20 years. At the end of that, I feel good about it. And in most cases, most people simply focus on the fact that they can double their money and they think that they're building wealth, but all they're really doing is making money. James takes the same dollar and has the same investment opportunity and the same 20 years, doubling every year. James says, I don't want to make money, I want to build wealth. So James takes the dollar and puts it into a Roth IRA first. Now it costs James a quarter because Roth is taxed upfront, right? So James had to pay tax on his dollar. So for 25 cents, James just bought tax-free growth on that dollar. So year one, when it makes $1, now he has $2. Instead of paying 25% tax, it's tax-free. Now he takes $2 and it becomes $4. Instead of paying tax on the $2 he earned, it's tax-free. His $4 becomes $8, and you get the idea. I'll ask you guys to type into the chat just because I love to hear the different answers. But by not paying the 25% tax year over year, how much money will Jim have at the end of 20 years? And I will give you a hint. It's more than the $78,000 I will have, right? So go ahead. I'm going to grab some water. What do you think? I see 250 grand. There's no wrong answer. Don't worry. What do you guys think? 375. What else is out there? How much money does just simply paying that 25% tax year over year actually cost you over the course of 20 years? Any other guesses before we reveal the real number here? All right. I think you guys are too scared to attach a number to your name and run the risk of being off. So the closest number of 375 is less than half. The number is just over $1 million. So I want everyone to just pause for a second and ask yourself, are you investing to be the guy or gal that has 78 grand? Are you investing to be the guy or gal that has $1 million? And remember, the only thing that separates me and James in this scenario is not how much we started with. It's not what we invested in. It's the fact that we used the tax advantage of an IRA, in this case, a Roth, to eliminate Uncle Sam from our deals. So I want everyone to be thinking about that, because if you're leaving money on the table, you don't realize it. Every time you do a deal that has Uncle Sam involved, you are eliminating your ability to build wealth. And so many people focus on making money, right? What's my ROI? What's my ROI? How much am I going to make on this deal? That they forget the tax efficiency that may actually give them more money when it's all said and done. So regardless of what side of the aisle you sit on, regardless of your thoughts on tax or not, IRAs are a readily available tax tool to every investor on this call. So this isn't anything you need a slew of CPAs to help you with. This isn't questionable tax practices. This is everyday readily available tax law to eliminate Uncle Sam on your deals. Now, should you do every deal in an IRA? No, because that money's being deferred out for a longer period of time. But should you be looking at the deal and really evaluating what kind of earnings you're going to have off it? What are the benefits? How soon are you going to make the money? And deciding if it's a better tool for your IRA or if it's a better tool for you personally? Yes. So if you want to truly build wealth, you have to start factoring in the tax opportunity as it relates to your investments. If you just want to make money, ignore what I'm saying and keep doing what you're doing in your personal account, and you'll be fine at the end of the day. You'll be doing better than most. But true wealth is built over time from a tax perspective and a good investing strategy. So I can see it on my end, James, actually pretty easily. So I guess, Nicole, you've got your hand up. Am I seeing this right?
You are seeing it right.
All right. What's your question?
Well, my question is basically with the new proposals that are coming down from the Biden administration about the tax on capital gains. I think it makes us even more. They're saying those of us who are making significant amount of money are looking at paying 40% on capital gains. And if you're in an IRA, particularly a Roth, that isn't going to apply. Is that correct?
Yeah, Nicole, you're spot on. I mean, obviously, the tax law as it's changing can be favorable or unfavorable. In this case, this is catering even more to an IRA. And what it's doing, Nicole, is really challenging us as investors to look at the deal even more aggressively to say, if it's short term, it almost guaranteed makes sense better in an IRA because the tax rates are getting so much higher. But yeah, no doubt about it. The current, anytime taxes go up, IRAs look more attractive. And the beauty is, while IRAs continue to be under some level of scrutiny, there's always some congressional party that's putting something on the table. There's yet to be any tax law change that hasn't been more favorable in my 16 years that actually encourages IRAs, encourages the Roth. They're doing more to get people into IRAs because if you think about it, and most people may not know this, so the way that it works in Congress, and I may be preaching to you guys since you're so close, but everything they do is on a 10-year period. They can make a decision that literally will cause us to go bankrupt in 10 years in a day, and they don't care. They don't have to explain what happens on the day after the 10th year. They have to explain for 10 years. Well, if you think about it, what type of IRA actually calculates better into a 10-year plan, pre-tax or post-tax? So they've only encouraged Roth IRAs, not discouraged them, because it creates tax revenue into the Treasury today. And they're finding that they're actually better off with the money today than they are tomorrow because it gives them efficiencies with the money. Even though it benefits us gravely, it actually is one of the few things that's a true win-win. So the administration certainly is making things look more attractive. Thank you, Nicole. Carmelo. Go ahead, Nicole. Do you have something else? I'm sorry.
Yeah, I'm going to let Carmelo come in, and then I have an actual question. But let's get Carmelo first. Carmelo.
Hey, I want to know, what do you do if someone makes more than 125, 135,000? Because that's usually the limit that you can make to be able to use a Roth IRA. Can you explain that a little bit? If there's any ways around that, or if it's possible?
Yeah, and actually, kind of what I was mentioning somewhat anecdotally is actually what you just said. So there is a limit to contribute to a Roth IRA. That means if I want to make an annual contribution, and I don't know the numbers, it's somewhere around 120 and then like 180 filing jointly, where you're phased out. So if you file jointly and make $200,000, you cannot contribute to a Roth IRA. However, back in 2010, they changed the tax law on Roth conversions. So it used to be where there was a Roth conversion limit of $100,000, which was below the contribution. So in theory, if you couldn't contribute, you were automatically ineligible to convert. In 2010, because they wanted to get they had all this tax revenue that was deferring in IRAs. They wanted to get it out quickly, right? Going back to that, they make decisions for 10 years for a budget. They did that. What's really interesting is in 2010, they created this opportunity where there was no longer a Roth conversion limit. That meant that if Carmelo makes $2 million, Carmelo could not contribute to an IRA. He's ineligible, but he could contribute to a traditional IRA and then turn around the next day and convert it to a Roth, which created this, we call it a backdoor Roth conversion. So everybody is eligible. And what's interesting is usually, and this is something, again, I don't want to get too political, but it's good to know when tax law things are changed. So generally, when you don't have bipartisan support, meaning both sides of the aisle are on the same page, usually what you have is a lot of sunset provisions. So the way they do that is, right, James proposes something. I don't really agree with it, but I'm willing to get on board because there's some stuff that he's willing to do as a concession to me. But the way that I resolve that is we'll sunset it. So we'll say, James, I'll do that, but we're going to sunset it in 6 years, 3 years, 2 years. And what that means is it'll revert back to whatever it was before. So it's a way to say, we'll give you a chance to prove that it works. And if it doesn't, it's going to revert back. What's interesting is that tax law change in 2010, it was not created as a sunset, which generally means there was true bipartisan support. And when you see that, it means that they all realize, again, regardless of what side of the aisle you sit on, that money in the Treasury today is better than money in the Treasury 20, 30 years from now. Even if it's a little bit less money, the time value of money for them works. And it favors us too. So it's one of the few things where the consumer, right, i.e. the taxpayer, and both sides of the aisle generally are on the same page. So there is no sunset. There's been no tax law changes that have touched that since 2010. We're going on our 11th year. So yeah, Roth conversions are available to everyone. And I would encourage everyone to consider a Roth conversion every year. I have a saying, it says a Roth conversion is not a matter of if you should convert, it's when you should convert, right? So you want to look at your assets. You want to look at their growth opportunity. You want to look at what's happened. So I'll wrap this up in a bow here. But if you saw the market, let's just say you were exclusively invested in stocks, March 20th of 2020, when the market dropped 35%, would have been a very opportune time to convert to a Roth. It may not have been the best tax decision for you because there was no change in the tax itself. But your asset value, if you had a $100,000 portfolio, is now worth 60 grand. And your Roth conversion, you would have only had to pay tax on 60 grand, not 100. And I share that because I'm going to talk a little bit later about how that works in the real estate market. And depending on the real estate deal you're doing, there may be what we call kind of that inverted bell curve, right? Where the market value of the asset actually goes down before it hockey sticks back up. And that can create some Roth conversion opportunities. So I really appreciate the question, Carmelo. Absolutely, Roth's available to you. Don't worry about your income. You just have to fill out an extra form or two.
Somebody actually sent me a private question. So in terms of your example from before, 75 cents to make $1 million over 20 years, what are the tax ramifications on the back end?
Well, if you do it in a Roth IRA, zero. You prepaid the tax, your growth is 100% tax-free. Now, obviously, that's an extreme example. If you did this in a pre-tax account, traditional SEP, simple, your tax liability would be based on the income as you withdraw it. So 30 years from now, or I guess my example is 20 years from now, James has $1 million in his account. If he takes 80 grand out that year, he pays tax on whatever 80 grand works out to be in his tax bracket at that time. Now, I would just tell you, this is where people have to think ahead and be willing to lay a little money on the table today for the benefit tomorrow. If you're making any investment that you believe is going to have double-digit returns on a consistent basis, I won't tell you to convert to a Roth IRA, but I would tell you, I would strongly consider it because you're buying growth. And if you're going to deliver that level of growth, 10, 12, 15%, you'll always come out ahead paying the tax, even if you're in the peak tax bracket today, because the amount you're going to end up with is going to be higher.
This is Nicole. I'm just jumping in for a minute. I really say that, people have laughed, but I think Roth IRAs are the seventh wonder of the financial world. I mean, they're just so powerful. And I have a specific question. So a lot of us who are multifamily investors, syndicate. So we get money from investors, from private investors. So I've had the question come up a couple of times, and I actually don't know the answer. Can somebody who is a passive investor invest both as a putting cash in from one of their regular accounts and invest from their IRA? So can they have two positions in that same investment?
Yeah, I mean, the answer is yes. And I try to kind of analogize it back to stocks, because I think what happens is so many times we think of IRAs buying something unique as creating this level of complexity, and it really is equally as simple. Could your IRA go buy 50 shares of Microsoft, and could you personally go buy 50 shares of Microsoft? And the answer is, of course. Your shares are registered to you. Your IRA shares are registered to your IRA, and it works no different. So, Nicole, if you're syndicating a deal and I can buy a unit for 50 grand, and I want to buy 1 unit in my IRA and 2 units personally, or vice versa, or however it works out, I can certainly do that. No questions asked. What it means is that they're each standalone investments. So whatever profit my unit in my IRA generates goes back to my IRA, just like my shares of Microsoft in my IRA. And whatever units I buy with my personal money all goes back to my personal account, just like I owned it personally. What you cannot do is you cannot buy, let's just say, a unit in each account, and then you realize that, hey, wait a minute, this is a real winner. I don't want these profits. I'm going to take that unit I own personally and tuck it into my IRA. Once you own it in your personal name, you can't move it to your IRA. So it's truly pro rata. Whatever your IRA buys, whatever you buy personally are separate. But absolutely, in fact, we see that all the time. It's becoming more and more common.
Thank you.
All right. So we actually kind of jumped a little bit ahead, and I'm really glad we did on Roth conversions and the opportunity that's presented there. So let me wrap up kind of this side of being an investor, which is the beauty of self-direction is you can actually use almost any kind of account, and some accounts that most people aren't even familiar with. So a Roth, right? Traditional is pre-tax. You pay the tax at the end. A Roth is post-tax. You pay the tax at the beginning. Roth is the account I would encourage every investor to at least assume that's the best account until you unravel it to where it doesn't make sense, rather than starting with traditional and maybe going to Roth. SEP and simple, don't worry too much about. If you're self-employed, the SEP may make sense. For those on the call that are truly self-employed, especially if you have no employees, I would encourage you to email me or to go onto our website and take a look at the solo QRP account. It's a solo 401k. We call it a solo QRP, but it's a plan that has by far the best option for someone to buy investments, but also the best option to add money. It has the highest contribution limits. It has a Roth component with no earning restrictions. So I encourage everybody, if you want to save your own money, to save through the Roth or through the solo QRP. If you qualify, there is no better plan. I won't go into too much detail on it because we don't have the time. But again, do some personal reviewing and reach out to me if you have questions. But those that are self-employed or have a way to make a little bit of self-employed money, even if it's a few $1,000s, I would encourage you to look at the solo QRP plan. No better plan out there that's available. The other thing I always encourage people to look at is HSAs and ESAs. I know many of the people on here, probably especially those that are self-employed, have high deductible health insurance programs. Well, the best part of high deductible health insurance is that you have the ability to open an HSA. An HSA allows you to save money on a tax-deferred basis on the way in and a tax-free basis on the way out. It's the only plan that's deferred and tax-free. So it's basically the benefit of a traditional and the benefit of a Roth in the same account. I would encourage you, if you have that, max that account out every year, even if you've got to, pull money out of your couch cushions. There is no more tax efficient way to operate. But the beauty is an HSA could buy real estate. So I can take my HSA over 3 to 4 years, put money into it, and go put 15 grand into a syndication deal tomorrow, and then generate the returns, whatever that syndication generates. So it is an incredible account. In my opinion, it's the account that I try to max out first because it's deductible and tax-free, regardless of your income. The other account for those with kids, grandkids, if you don't have kids or grandkids that you want to contribute for, I have two, and I'm happy to accept contributions into their accounts on your behalf. But the ESA is the same type of account. It works like a Roth for education. You can put a couple $1,000. It's not a lot per year, but that money can be invested. So we have a 9-year-old. He's got over $25,000 in an ESA. We put in $2,000. We've been buying promissory notes. Over the years, we've done some small real estate deals as a small partner, but we've been able to grow that account pretty well in 9 years. I think we've only put $16,000 into it ourselves, and it's approaching $30,000. And it's because it's allowed us to use that money as a tool. So when he gets to college or even pre-college for private education, we can take money out of that to pay for it, which is amazing. So I don't want to spend too much time on those, but I would be remiss not to share that really building wealth is all about putting as much money into as many pots that have the most tax advantage, and then figuring out how to put those out into the investment world. Carmelo, you got your hand up again. What's your question?
Yeah, you just touched on something that I'm actually pretty familiar with, which is the investing for your children. What did you say that? What vehicle, tax saving vehicle do you have for your children's college or your children's fund? What did you mention?
It's called a covered Dell educational savings account, or just an educational savings account, either a CESA, CISA, or ESA. So this is one of those accounts that it does have an earning limit. So you're going to have to work around that. The beauty is anybody can contribute. So, we're ineligible to make the contribution ourselves. So we have an aunt or uncle that we gift, conveniently money to. We stay under the gifting rules. We don't have to file it on our taxes or anything. And then they make a contribution to our kids' account. And so it works out. It's pretty easy and straightforward. They report the contribution on their taxes, and our kids end up with really nice aunts and uncles that are willing to contribute on their behalf.
Are you, so I work in real estate. Are you familiar with using an IUL as a tax vehicle that you can also use for your children or yourself, that actually has no limitations as far as contributions and withdrawals or distributions?
No, so this is where I mentioned earlier that I get to learn from you guys. So we're switching seats here, Carmelo. Just give me what that acronym means so I can go do a little research on my own.
So it's called an Index Universal Life Insurance Fund. And pretty much it's a life insurance policy that goes with the S&P 500, which is the 500 top stocks in US. The way that we do it is that we have one that's actually like an S&P 500, but for the world. So because of the way it's set up, you actually never lose principal. So if that stock or the market goes negative 1 year, you still keep your principal and you only access the gains of it. And the good thing about it also is that you can use the money no matter how old you are. You don't have to wait till 59 and a half. It comes out tax-free, and you can actually take a loan against it, and the money still grows as if you never took the loan out.
Interesting. I will definitely have to do a little digging on that. I'm familiar with some of the life insurance policies. I personally have never used it, but I've not heard it referred to as an IUL, and I appreciate that. I will go take a look, and I would encourage everyone else on here. IRAs are not the only wealth building tool, and anything that anytime you say tax deferred, tax advantage, my ears perk up, because I can be a mediocre investor with good tax benefits and win the game, where there's a lot of people that are great investors but horrible on the tax side, and chances are we'll probably outperform them in the long run. So I appreciate it. Thanks, Carmelo.
So we had a question. We had a question from Seifa that says, when does converting to a Roth not make sense because of the age factor?
So the answer to that is, in my opinion, age wouldn't keep me from doing it. I look at it the other way, which is growth periods, which is, I consider in years. So, I have clients that are 80 years old that convert to a Roth. If they plan on having another 10, 12 years of growth in that account, it really doesn't matter. Somebody 50 that's going to take it out at 60 is going to have the same amount of compounding periods as someone 80 that's going to take it out at 90. Roths are a great tax building strategy for transfer of wealth. So we see a lot of people that may be aging to a point where maybe the mathematics of conversion don't make sense. But when you pass an IRA down, your kids can take it over 10 years or grandkids. So if you have $1 million in a traditional IRA and you're 70 years old, well, first of all, you're going to have to start taking money out at 72, right? So converting avoids that in future years. But if you take that money and convert it, and let's say you never use it, maybe you have other passive income. And I'd imagine almost everybody on here, you guys are all working on building passive wealth. So you may not need your IRA. And so you may be able to pay the tax, even if it seems high, or maybe if it seems like it's not going to be as valuable for the amount of time you have. But if you can make that Roth conversion and know that you can pass it down to your kids or grandkids, and they're going to get 10 more years after your life expectancy, and they're going to get to grow it tax-free too. So they can take it out year 2, year 4, year 6, year 8, year 10 as they deem fit, as long as it's gone within year 10, and take advantage of all the tax benefits and keep growing it tax-free.
Right.
All right. So let's shift gears. We've got about maybe 10 minutes or so. Let's shift gears to what the syndication side. So we talked a little bit about, obviously as an investor, this makes great sense. It's an IRA, it's tax-free, tax advantage, et cetera. We talked about the different types of accounts, but let's turn the tables now and talk about as a syndicator. So I'm going to go buy a storage facility, multifamily property, RV park, whatever I think mobile home is the appropriate terminology, but whatever the investment may be. And I want to go out and syndicate it. Maybe I'm going to raise $2, $3, $4, $5, $20 million to get this deal over the finish line. So as you're out talking to investors, for you as a syndicator, you really don't care where the money comes from, right? I mean, in theory, if I approach James writes me a $200,000 check. I don't really care. I just want the 200 grand, and I need as many Jameses as it takes to fill the syndication. But I'll talk a little bit about why maybe you should care, and why helping people like James understand how the IRA works can benefit you in the long run. So if I'm approaching James and as a syndicator, right, and I'm obviously following any sort of solicitation guidelines that exist based on my offering, but assuming I'm doing that and I sit down with James and James is very interested in the deal, that's step one, right? It doesn't matter if I talk about IRAs, ESAs, IULs. At the end of the day, if James doesn't like the deal, it doesn't matter. So once James is interested in this deal, then the question becomes, well, one, how does he invest? And two, how much can he invest? The reason that we always recommend that every syndicator have a custodian like NuView on speed dial is because James has a lot of reasons why he may want to use his IRA. We talked about the tax benefits, and James may not even realize that. But I'll share the first thing, which is the first bit is passive income in a tax advantaged environment creates patient money. So in a syndication, right, I may be looking at this deal with an exit strategy 3 years, 5 years, but let's face it, it could become 5 to 7. It could be 7 to 9. We don't know what the market holds. We have a plan and we want to execute that. But when James puts his personal money in year 3, if that deal's not sold, James didn't hear 3 to 5, possibly 7. James heard 3. So what's James doing? Hey, Junior's going to college. Billy, needs braces. Whatever it is, James is at my throat saying, where's my money? Where's my money? And as much as I can tell him, hey, this is what you signed up for, it creates challenges. Well, in an IRA, James isn't touching that money for years. And it's mailbox money, right? I'm putting my 8% pref into James's account every quarter, semi-annually, every year. James is sitting back saying, oh man, and what's James doing? He's at the golf course, he's at the country club, he's at dinner, and he's telling all his friends, you're not going to believe this, but I'm making an 8% preferred return every single month in my IRA. I haven't had to think twice about it. You need to call Jason because this guy can help you do the same thing, right? So it creates a patient level of money for me as the sponsor to not be bombarded with the need for money, but it also creates this advocate in James that's going to go out and tell the story, because let's face it, people want to talk about success, but people also want to talk about success in an area that's unique, right? So the uniqueness is two-part. One, I invested in that building, that we're driving by that people store stuff in, or I invested in that, mobile home park that's 20 miles outside of town. And that's a compelling story. But the other part that's even more compelling is I used an IRA to do something like real estate, right? Telling someone you bought a stock that went up isn't really exciting other than the fact the stock went up. But talking about an asset class that most people will never invest into on their own, but also that has tax benefits and in an IRA, starts to look really attractive. So you create patient tax advantage money, which James loves and I love. And I'm a firm believer, if you want to be successful as a syndicator, it's got to be a win-win, right? My vision has to be aligned with James, or it's not going to end well. This deal may work, the next deal will blow up, or the next deal. So, creating that patient money stream, for those of you that have syndicated, you're probably thinking to yourself, yeah, I can think of many calls that I got of people needing money out of the deal that I just wasn't prepared to get, or didn't have the capital, or wasn't at an exit that made sense. So what does that mean, that I would go to James and only take his money if it's an IRA? Of course not. Right. But back to Nicole's point, they can invest both. And if I can help James see the value proposition in the deal, then I may be able to get James to put 200 out of his personal account and 200 out of his IRA. And I may be able to add money to that syndication through one investor versus having to go sell that deal or invite another person into that deal. I'll pause there. Questions? Make sense? Thoughts on that?
So if you have invested in your IRA, this is Nicole again, and now it's time to sell that asset, right? So I can, if I'm selling it from an IRA, I don't have the capital gains. I don't have the tax to deal with right then. And so that's a clear advantage. But can I 1031 exchange that? So could I take that money? Actually, I won't need to. Never mind. Belay that. I don't really need to do that in an IRA.
No, it's a great question, Nicole. And you answered it yourself, but I'm going to add to that. So a 1031 is basically used. It is the best. It's as close as you can get in a real estate deal in your personal name to look like what an IRA deal looks like every day. And I want everyone to think about that, because a 1031 simply says, IRS, I made $100,000 and I'm willing to identify a new property and close within 180 days and declare it a 1031. And you agree not to tax me till some point in the future. The beauty is, well, and that while that's a great tool, it comes with lots of challenges, right? You have a certain period of time to identify, et cetera. The beauty is, in an IRA, think of it like an automatic 1031 exchange. You don't have to do anything. So I invest into James's deal. I put $200,000 in. The deal closes. Let's just say I made $300,000 or I made $100,000. I have $300,000. I don't have to re-identify. I could go out the next day and go buy a stock with it. I could go out the next day and write a loan. I could invest into a similar type of property, or I could invest or leave it in cash for 6 months because I don't think there's good yield. The risk curve is too high. It doesn't matter the rationale. The beauty is I don't have to even think about it. It's autopilot, right? So 1031 exchanges are a great tool, but number one, they're under incredible scrutiny, and I would be shocked if they made it through the Biden administration. And I don't say that because it's Biden. I say that because they've been on the docket well before Trump to be eliminated. And I think Trump, being a real estate guy by nature, had no interest in any sort of congressional decision that would consider that as an option. But I think you're going to see that be incredibly, under scrutiny. Whereas IRAs, because if you think about it, really 1031s, most people they're mostly investors. They're mostly high net worth people that use them. So they're easy to put under fire and not really hurt your base. IRAs are used by everyone. 401ks are used by everyone. So you make a tax law change to that, and your base is going to be upset no matter what you do and no matter what your base is. So great question, Nicole. Thanks for kind of teeing that up a little bit. And it's very common. Most people think there's something they have to do to get the tax deferral. And the reality is you don't.
Hey, David, I'm not sure I understand your question. Do you want to unmute and just ask directly?
Yeah, sure. When you're looking for investors, how would you structure it if there's a majority of people who have like self-directed IRAs? Would it still fall under 506B or C?
This is Nicole. You could use either. It doesn't really matter. The difference with C is you have to be able to, the investor has to be able to prove that they're through a bank account or an IRA or something that they actually are accredited investor.
Okay, thank you. Can I ask a follow-up question?
Sure.
Go ahead.
Great. So, if you're coming up on like the 5-year hold period where you used your IRA money initially, and you're gonna get your initial capital back, how easy would it be to roll over to the next deal? Are there like tax implications involved, or do you have to get like accountants to roll over to the next, or is it like a seamless transition where you find another deal and you just roll the money over?
Yeah, I
Am I
mean,
making sense? Okay.
no, I think I understand the question, and thank you, David, right, for
Yeah,
chiming in. So think of it just like a stock, right? So let's just say you put $100,000 into Microsoft, and 5 years later you sold your shares of Microsoft and you received cash, right? And assume you made money. It doesn't matter how much. Now you're in a cash position. The next day, that afternoon, you go back online, you go through Schwab, and you say, I want to buy $200,000 worth of Apple. And you execute that purchase. It looks the exact same inside a self-directed account. So you put $100,000 into a syndication deal. 5 years later, that syndication deal liquidates, and your $100,000 becomes $300,000. You now have $300,000 in cash. Later that afternoon, the next day, you want to go invest into Sally's syndication, and this time you're going to put 100 there. You're going to put 100 into James's and 100 in Nicole's, and you simply buy all three. And now, instead of being in a cash position, you have 3 syndications in your deal. Back to your original question, whether they're C, B, D, it really doesn't matter. That's a decision you make that's best for you as a syndicator, but it won't impact whether or not an individual investor can invest. The only thing that we always recommend is an IRA doesn't change any of your solicitation rules, nor does it change any of your accredited investor requirements. So if I'm required to be accredited, I have to be accredited whether I use my IRA or not. If I have to validate I'm accredited by a statement from my CPA or a bank account, I would have to do that whether I use my IRA or not. So it doesn't change your offering. It doesn't change your approach. In fact, I suggest that you don't even try to raise money from IRAs, raise money the way you would normally raise monies. Just invite people to use their IRA in addition. But you're not going to go change your strategy at all. The way you raise money is the way you raise money. If James is a good potential investor for me, I'm not going to think he's a better investor based on his IRA or not. He may become a better investor because he's got $1 million in an IRA that I didn't know, but I still have to go target James the way I would target him regularly. If he's got an IRA that's sizable and wants to put more money in the deal, that's just icing on the cake.
Thank you.
Ken, you've got your hand up.
Yeah, thanks. As it relates to being a passive investor in the syndication, I've heard of something referred to as a UBIT tax, and that would apply in a self-directed IRA. Can you elaborate on that or explain to me what it is, I guess?
Yeah, happy to. So you're absolutely right. There is a tax. It's actually, it is technically not UBIT that's applicable. It's UBIT's cousin, UDFI, which is UDFI. UDFI stands for Unrelated Debt Financed Income. UBIT stands for Unrelated Business Income Tax. UBIT and UDFI are cousins. They apply and they're under the same code. Here's the logic behind it. You won't hear me say this often, but it's actually a logical tax. So when an IRA engages into leveraged real estate, the IRS says we have to tax the IRA on the leveraged return because it's earning money off of non-IRA money. So for example, if I invest $50,000, and I'll use just an example that of a 50% leverage, but if I invest 50% in $50,000 into a deal, but in reality, they're going to go leverage my 50 to make it 100. I'm getting a return in theory off of $100,000, not 50,000, because I'm getting a levered return. The IRS says we won't tax your IRA if the entity pays tax. So this is why you don't pay UBIT or UDFI tax when you buy Microsoft, because Microsoft is a tax-paying entity. So Microsoft is paying corporate level taxes and leverage level taxes at the entity level. But because this is an offering that likely is some sort of pass-through entity, LLC, LP, the IRS says, because you're getting the full return, we're not going to hit you with tax. You're not paying double tax. So I want to be clear, the tax here shouldn't be scary, because in reality, if Microsoft was an LLC instead of a C Corp, I would return way more money because I wouldn't have the tax taken out first. So when UBIT applies, yes, my IRA has to pay it. As a general rule, I only have I don't make enough money year over year to pay it in most of these syndication deals, because I'm not generating a whole lot of revenue year over year. Where I typically have to pay it is when the property is sold. And that's because I'm going to generate a sizable return. The beauty of that tax is, number one, if I have a loss year over year, which is not uncommon, I can carry that over to the end so I can offset my tax liability. Number two, when you factor out a cash on cash deal versus a levered deal, my return is exponentially higher in a levered deal, even after the tax.
Yeah.
Number three, I'm only paying tax on the levered portion of the gain. So if at the end of year 5, I return $100,000 of profit, forget about principal, that $100,000 is not subject to tax. If it was levered 50%, then only $50,000 of that $100,000 is subject to tax. So my tax generally tends to be pretty de minimis. Lastly, and I didn't want to kind of murky the waters, but since it's been brought up, if you do that deal through a solo QRP, you are exempt from the tax for acquisition debt. So for those of you on the call that are passive investors, you need to figure out how to get into a solo QRP, and our team can help you not skirt the tax law, but truly create self-employed income, which most of you probably have. And if you don't, it's very simple to create. You could start an eBay store and make $1,000, and technically you're self-employed. And you can move your money into the solo QRP and eliminate UBIT tax from your life. So I kind of gave you the, I don't know, maybe 5-minute Reader's Digest version of kind of how that works. We have, if you go onto our website at NuViewTrust.com, go to the blog section, we've recorded full-blown webinars just talking about UBIT and UDFI. Obviously it's a tax you need to be aware of. It's not a tax that should scare you away from a deal, but we would encourage all of the clients to see if they can qualify for the solo QRP account, and then you don't even have to consider the tax. So hopefully, Ivan, that answered your question and gave you some insight.
Yeah, actually, my follow-up to that was going to be about the QRP, so thank you.
Yeah, it's the best tool that exists because of all the reasons we mentioned. But the kicker is that UBIT exemption. So for those that are passive investors, we set up a ton of these things every day.
Now,
We talk.
So go ahead, Ivan, and then Nicole.
So if you're a W-2 employee right now with a 401k, later down the line after you leave your job, can you roll that 401k into the QRP?
Yeah, you sure can. And I don't know if you were asking this kind of in context, but I'm a W-2 employee at NuView. I could go out and start a landscaping business on the side because I cut 3 of my neighbors' grass, right? Or a little eBay store or consulting where someone pays me a few $1,000 and I tell them what information, or I own rental property. I could choose to take that rental property and charge the entities that I own them in a management fee. All of that would equate to self-employed income. I can have both a 401k at my company and a solo QRP. Now, what I cannot do is I cannot contribute over the annual limit as an employee in each of those. It's combined. But what it would allow me to do is put the money into either plan. But now I qualify for this QRP, right? I can now use whatever money I'm able to get into that account, whether it's old IRA, old 401k, and I can do my syndications in there while I'm an active employee. And then, Ivan, when you leave your corporate job, you then become eligible to roll that money too into your QRP.
Excellent. Thank you.
Nicole, you were going to either ask something or had a question or comment.
I was going to actually ask something. So we've talked about passive investors. What about how do you set this up if somebody has money and they're wanting to be a joint venture partner because of basically IRS rules that said they have to be actively involved in the deal? And I think that's probably not so easy to do if you're investing through an IRA. So how would we do that?
Yeah, I think, you kind of already hit it. It's not as easy to do. I won't say you can do it, and I won't say you can't do it. So anytime that you're taking an active role, whatever that active role is defined as, you run the risk of the IRS saying you lost your tax benefit because you overstepped the passive status of your IRA. Think of this like Jeff Bezos using his IRA to buy shares of Amazon. In today's environment, he probably could do it because he's so far removed and passive enough, but he'd have to follow the insider trading guidelines. Years and years ago, when it was privately traded, he really was unable to do it because there'd be no way for him to prove that he was truly passive. His active role had a advantageous benefit on his investment. In real estate or in syndications or joint ventures, it really depends on two things. I mean, one is how active are you, right? And then number two, how willing are you to defend it in the event, rare, but event that the IRS looked at it. We always suggest, get some good legal counsel to look at it and bless it. I do have people that have done it. You're going to sign enough disclosures with us, no matter what you do, that says you're a custodian and you're not responsible. Our trust charter is in the state of South Dakota. There's plenty of court cases where they will tell you we are not responsible. Invest in something that's prohibited. It's your problem. Invest in something that's illegal. It's your problem. I'm not saying that as if we don't care or we bury our head in the sand, but this is the area where you do get, in a self-directed account, you do get to be behind the wheel. And it's the benefit, and I encourage all the clients to go seek legal counsel to the point that you're willing to defend it. And if you feel like your legal counsel says you're close enough or that you have enough coverage, I want clients to take advantage of every opportunity self-directed offer, so long as they're informed.
Thank you.
Well, I don't have a whole lot more. I mean, other than I could kind of talk a little bit more about some of the nuances, but at the end of the day, I think we've covered so much. I really appreciate all the questions that have been asked so far. So, I know we're at or certainly over time. So I'll maybe turn it over to you, James, and you can kind of tell me how to wrap up and what's best.
Sure. So I think we have a small enough group on the call that if you have any questions you want to ask, you don't have to raise your hand. Just go ahead and unmute yourself and go ahead and ask, and then we'll just work it out as we go. So any questions from anybody that you have for Jason that maybe you didn't get a chance to ask earlier?
Could Jason tell us all his contact information and how, if anybody wants to have some money they want to invest or start a 401k, solo 401k, or some of these other things he's talked about, how do they get in touch with you, Jason?
Yeah, thanks, Nicole. So, if you want to learn a little bit more, our website is NuViewTrust.com. So it's NuView Trust.com. You can take a look there. There's lots of videos and things that you may want to look at, depending on kind of where you are in terms of understanding and how much more information you feel compelled to go look at. If you have questions, I'll repeat my email from the beginning, but it's jason@NuViewTrust.com. And I would encourage you, if you have any questions or anything that you just were maybe uncomfortable asking because it was either you thought it may be too entry level or it was personal and you didn't want to put it out in the public, please get those typed up. You can send those to me. We'll get those responded to. That's the best way to get to me. If you do want to call our office, the number's all on the website, and you can reach out directly to our office from there.
Also typed in Jason's email address into the chat if you just want to cut and paste it from there. So any other questions? Anybody have anything they want to ask before we wrap it up?
Yeah, I had one more, James. Jason, what does the fee structure typically look like for a plan like this?
So we have two divisions. I'll talk about our retail division. One of the things that separates us from a lot of our competitors is we have a institutional division typically. And that, just so you guys have perspective, that division deals with capital raises well in excess of $1 billion. Obviously, I don't think anyone here is planning to raise $1 billion, but that's a division that deals with financial advisors that sell large scale non-public investment offerings. But we do have some syndicators that when I say graduate into that do either do enough deals in a year or turn enough clients over in a year to meet that criteria. So I say that because if you're dealing in a more volume, we can talk offline about getting to that. I won't go through that pricing just because it may not matter. But if you do think you may want to inquire, that's something that we do. But our pricing it's $50 to open the account, $95 to invest in the syndication, and $295 a year to hold it. So whether your investor puts in 20 grand, 50 grand, 500 grand, or $1 million, it's $295 a year to hold the position.
Great, thank you.
Sure.
Awesome. Anybody else have any questions? Going once, going twice. Okay, I guess that's it. Jason, thanks so much for taking the time in your new house, hanging out by the pool. We really appreciate you taking the time and sharing all this great information with us. Like I said earlier in the call, we're going to go ahead and take the video with all of Jason's information and his contact information and put it on our YouTube page and our Facebook page. And I will actually make sure that if you are on our Meetup list or you're on our regular mailing list, I'll make sure that I send that out to everybody probably on Monday or Tuesday at the latest. So we'll be back the fourth Wednesday of every month with another speaker. Jason, thanks again so much. We appreciate all your time.
I almost lost you guys there. Thank you guys, everybody, for your time. Thanks, James. Thanks, Nicole, for having me. Y'all take care.
All right.
You too.
All right.
Thanks, James.